When you're investing, you always have to think of the next stage. If what you're investing in or what you're raising for will be something that the next stage of investors will be involved with or not. Like as an angel, I always look and try to understand if a VC fund will be investing into this company.
Hello, everyone, and welcome back to this new episode of the Fundraising Insiders podcast, the podcast where we put what happens behind the check and we put it inside the deck. Today, we have an episode that is really well in the theme because we are looking at someone who is doing checks professionally. That's your main job, is being an angel investor. And that's very interesting because it means that in a way, all of your eggs are in that basket of being an angel investor. Usually when we receive angel investor, they are a retired entrepreneur who does a bit of angel investment, but also has so many things on the side. And here we're going to hear about how to do it in the most pure fashion. And I'm really, really excited about this. I should have actually started not by saying hello, but përshëndetje. Am I pronouncing it correctly?
Yeah, yes, yeah, that's correct.
This is the Albanian way of saying hi or
Yeah.
hello. And yeah, today I am with Shefqet. Chef, you told me I could call you Chef, which
Yep.
I love it. It's a great nickname. And you're going to tell us all about how you became a professional angel investor. What is the kind of title you give yourself?
Angel investor, that's it.
That's it. So we'll look into your background, how you got to become an angel investor, from who you learned it from as well, which is a very interesting story you'll tell us, and about your portfolio, which actually looks pretty good. I think you were teasing in the last call that you had another exit coming soon. So I won't say more than this because you will tell us all about it. Chef, please introduce yourself, who you are, what's your background, academically, professionally, and how you came to do what you're doing today.
Yeah, so thank you for having me, first of all. So I'm Shefqet Avdullau, but I I go by Chef, and it's a funny way of how I got that nickname. My background is in tech, basically. So I was a software engineer for over 13 years and worked mostly with US customers and few UK as well. And while I was working with US customers, they were trying to pronounce my name basically, Shefqet, trying to, butcher it any way they could. And one day, one customer called me Chef, and I said, "Aha, you can say Chef." But so that's it. That's how I got stuck
all of
with
the
it.
language
So
will get it right.
yeah, so Chef, and that's how I got it. And then that's how I got started basically as a software engineer. Did that for 13 years. And then I moved on to building my own ventures. I had a few small exits here locally in Albania and a meaningful exit about 4.5 years ago, a BPO company here locally. And then I came to the point where I, could go on and build one more company, solve one more problem, or, leverage all that I had gathered in terms of capital, expertise, and network to go on and help other founders build, I don't know, 10, 20, 30, hopefully 50 companies and solve as many problems. And that's exactly what I decided to do. And that's where that's what I've been doing for the last 4.5 years. Angel investing and strategic advising. I've done 22 investments. I've got 2 exits and another, as you teased, loading up. Basically, the company has gone public, but I have not received the shares yet. And that's going to be when I'm going to, actually, the shares are in the process, but I will see when I will actually finalize my exit, basically. That's the whole point that I'm trying to make.
Gotcha.
And that will be my third exit, basically. And this is basically what I've been doing. And my focus has been in fintech, ad tech, and healthcare. So that's where I'm focused, primarily in UK, US, geography-wise. And so this is a little bit about my journey. And when I started this journey on the investor side, I was lucky that I joined a group of investors, and one of the investors there became a mentor, and he basically gave me the head start that have taken me 15, 20 years to actually learn on my own. Taught all the pitfalls or how to do proper due diligence. The strategy that I'm currently following for investments is basically something that he helped me build. So yeah,
Right.
that's about me.
So of course we don't have 15 or 20 years, and I think we don't have either the amount of time you spent with your mentor. But it's very interesting. I think you mentioned in our last discussion that this mentor came from a PE background. So it's something that's at a much higher stage, while you invest mainly in early stage. I believe health tech is one where you invest a bit later stage because your main thing is invest in things you understand. which is
Yeah.
something at the core of your thesis, and we'll talk about it later. That's interesting. How come a PE person, someone with a private equity background, came to do angel investing themselves and then teach you to do angel investing? We're going from a very late stage and working our way down to the early stage. What are the differences in the late stage and the early stage, and how come they taught you the early stage, or how come you wanted to do the early and not the late stage? Tell us about the difference there.
Right. So, so basically, they had gone through the whole cycle. See, they had done angel investing and then managed the VC fund, and now they're focused in PE. So they
Right.
had gone through all the, and they also do a little. I mean, I'm saying he also does a little bit of angel investing on the side now, but he's primarily focused in PE.
Gotcha.
And so he has, he had all that experience for all the stages basically, and that's why I love that, because he could share things that you generally don't get if you're just doing one of the stages. And that's the really really important part that's important for investors but also for founders, is that when you're raising and when you're investing, you always have to think of the next stage. If what you're investing in or what you're raising for will be something that the next stage of investors will be involved with or not. Like as an angel, I always look and try to understand if a VC fund will be investing into this company. And if they don't invest, there's chances are that I'm not going to be involved with the deal, because if they need that capital down the road, angels cannot help them get funded forever. Angels will help up to a certain point and a certain amount of capital, but then when you need that considerable more capital, you need to reach to this next level of investors, and that's VCs. And so basically, those are the things that you generally don't learn when you're focused in one stage of the whole process.
Right.
And how it is different, it's different because they focus on like on P focus on getting these profitable businesses, whereas as an angel I focus in the potential of this business growing to a certain level, let's say hopefully 100x in 5-7 years. But that's that's the projection, the hopeful case, the best case. But
Right.
if we aim for that, chances are that we are going to get somewhere close or even halfway. That it's still a good approach to all that.
So you build a thesis from essentially scratch. You already teased a little bit about the domains in which you invest. Can you tell us a bit more about that thesis? And also, when I feel like a lot of founders, when we tell them about a thesis or when they ask a VC for a thesis, they don't really know what they're expecting to hear as an answer. Is it just geography, domain, and check size? But there's more to it. Are you leading? Are you going to do follow-on rounds? What else comes? What is the vision beyond it? How are you returning to your LPs, etc.? In the case of an angel, you don't have the LP part, but can you explain exactly what is a thesis, what comes in a thesis, and what is not part of the thesis, so that we at least frame it, we frame our discussion before exploring it?
Right. So, I mean, the theses are primarily things that would align an investment opportunity or not align with what you're focused on. So things that you prefer or don't prefer. So in my particular case, I have things that I'm focused on in terms of geography, verticals, and then also founder preferences. So in terms of their prior experience is also important to me, if they have had prior exits and so on, or at least prior ventures. And things that I don't like, for example, and things that I'm not focused on is, for example, crypto or Web3, all this stuff that to me it seems like there are solutions in search of a problem, but so that's basically what the thesis will be then. And you have to be aligned with that thesis so the investor can consider you in the first place. And that's the important part, that as a founder you need to understand if there is any sort of alignment. Now, there will be investors or funds that make that thesis available publicly. I personally do, because I love to help founders any way I can, but some don't, and especially on the angel side, they don't, because most of the time angels will be doing something else as well, not just investing. They might be employed or anywhere else, and they don't make that side of angel investing so publicly. And in that case, you have to look into their portfolio companies, which verticals they've invested in, geography, and so on and so forth. So there are different things that the investors can decide to put on their own thesis. And so other things would be stage, for example. Some investors invest in early, let's say pre-seed or seed stage. Some prefer very, very late stage and so on. Like in my example, in my case, I invest for fintech ad tech. I'm stage agnostic for those ones. I could make an investment in any of those stages, but for healthcare, I prefer to come in a little bit late because I want the science part to be proven. It's the part that I don't understand most, and so I prefer to come in late seed or early Series A for those, for those kind of deals because I want the science part to be proven, and then I come in at where the commercialization part is starting. And that's where I can also, understand, but also see if I can help in any way I can to also increase the value of the company that way.
I see.
Yeah, so there are many things there are things in the thesis that investors decide, and and for the VC funds is their mandate basically what they have told to their LPs that they will be investing in, and so generally the VC funds will be more strict towards that because otherwise they will have their LPs will not like it when they go outside of what they agreed on, and they will, in most cases, will be more focused in just, let's say, one vertical and one stage and one geography and whatever. So you have to look up those theses and understand before you approach if you're aligned or not. Otherwise, you're just wasting your time.
I see. You are quite an active angel. I believe you mentioned to me that you have like 7 or 8 calls every day. And one might ask, okay, but what do you do in those 7 to 8 calls? I mean, it's a full-time job, and some angels are more hands-on, some are less hands-on. VCs as well, some are more hands-on, some are less hands-on. What do you do exactly in those calls? Because there are so many investors will tell you, we don't only bring money, we're bringing smart money. And this seems to be really the innovation in venture capital in general, not just VCs, but also angel investors, CVC, even family offices to a certain extent. Everyone wants to bring additionality. What is your perception of additionality? How do you bring it? And what format does it take? Is it just a 1-hour call every week? Do you have a certain structure that you follow, specific tools, processes? What do you do to be what you define an active angel?
Right. So in those calls, in those meetings that I take, it's not only with my portfolio companies. It's primarily with new, let's say, founders that I'm exploring in terms of investment, but also trying to find, opportunities for connecting them with my portfolio companies in terms of them, being a supplier or being a client, most important part. So that's one of the things that I try to help, trying to build synergies for my portfolio companies by doing those introductions with potential customers and other, types of synergies. The other thing is whenever have in my network aligned investors and when they're raising funds, I try to make those introductions as well, so we can close up the fundraising as fast as possible, and they start, executing and focusing on growing the business, basically. The other and obvious thing is I make myself available for them to reach out, ask questions, whatever bottlenecks they're stuck on. I'll be always willing to help. Of course, this is on a whenever I can basis, as an angel. Now, when they need dedicated time slots and cadence, I then offer my strategic advisory services, and I come on as a strategic advisor in those cases. But in general, I'm quite available to them also in this case where they ask me things and I answer when I can. The other way I support them is when they need talent. I reach out and see who I connect them with so they can get that talent on board as fast as possible and keep on growing the business. So these are few of the ways that I help and try to be as active as I can to increase the value of my investment that way as well, apart from the capital.
Is this something? I have so many follow-up questions actually. So first of all, is that something that you track? Like, for example, would you be able to say, I spend 20% of my time is supporting the founder directly in the one-on-one call. 10% is exploring talent. 30% is looking for synergies with external, so being client or provider. And then another 30% goes to exploring other founders, so working on your deal flow. Is this something that you track, or would you be able to say what are the main ones in what you said?
No, I mean, I don't track, but mostly it's these introductions for synergy
Right.
and investors. That's the biggest part, and of course, sometimes it's going to be the bottlenecks, but it's not something I track, you know. And some of the founders don't even approach for anything because they have things figured out, and I love that.
Mhm.
But some, you know, are more, you know, reach out more often. Some reach a little bit less often. And on my side, whenever I see a potential for synergies, I make the introduction. You know,
Right.
I don't think twice of that. So it's I don't keep track on those. I don't limit those. I just do anything that I see as a potential for increasing the value of the business.
And is this
So
something that you have been able to maybe quantify or evaluate the support you bring to a company? So let's say if you were to take a company, you invest, the money's there, you leave it, you don't do anything, versus the amount of work that you do. I don't know, maybe you have other angels in your network that are maybe more laid back because they have other occupations or they don't necessarily have the expertise. Do you really see an impact in the performance of those companies that you support actively? And if yes, what is that impact measured in mainly?
So the impact that I've generally seen is basically on the end line. It's the revenue growth. That's what my North Star
Right.
is. That if we can grow the revenue, then everything else will follow in terms of you know, the ability to grow the talent, the ability to raise funds and whatnot. So that's the main target that I have when I try to support them. And it's not something that I've tracked, but it's overall the you know, if you talk to my founders, especially those that have been very, you know, very much in touch with me, they will be telling you that, you know, the amount of help, and I keep, you know, saying and getting all this thanks and thanks and thanks all the time, you know, for the amount of help that I've been giving them, and absolutely love it. But you know, the real thing and where I get back all of that is when they keep on, you know, growing the revenue basically, and then they raise rounds at higher valuations, and that's where I see that, you know, what I put in, it's
Was
not
added
of
value.
course all of what I put in, but a small part of all that is basically what I had, you know, to do in that particular case, and
Right.
that helped grow the value of the business.
So before we move to the next part where we'll talk a bit maybe more in depth of do's and don'ts and maybe some of the learnings you inherited from your mentor and maybe let's try to concentrate this in this episode. Before we move to that, I have one final, a bit cheeky question because it's something we discussed before. With everything you're doing, with the really good performances that you're showing, I mean, 22 investments for 3 exits, there are a lot of funds that would, you know, they, they would kill to get those performances. But you do not want to create a fund. I asked you, hey, is this something that you want to upscale? Do you want to get more people? Because you're starting to have your own processes, you have your strategy, you have your thesis. You could expand this and you would think maybe as a founder, you want to create something bigger. But you told me specifically you don't want to create a fund. Just briefly, how, why, and what are maybe the limitations that you see in creating a fund that you wouldn't have anymore compared to maybe the freedom you have as an angel?
Right, yeah. I explored creating my venture fund a while back, about a year or so ago. And I have this approach, you know, when I get started on things, I try to ask people, try to validate my thoughts and all that. And in this instance, I reached out to, you know, venture fund managers that I know, and in one of those discussions, one of them told me something that I was always, you know, thinking on my head, but he kind of, you know, stamped
Crystallized it.
that all and validated basically. And he said, I don't like being a manager because as an angel, I like the founder, I like the idea, I love it, and I can, you know, decide to invest in them, and that's it. As a fund manager, it's the same thing, but then you need to write 4 or 6 pages to justify why you made that, you know, that decision. And it's more of a, you know, it's more of a bureaucracy rather than actual the enjoyable part, which is what I do now, just investing and talking to founders basically. And I don't like to deal much with that for now until I still have some dry powder to deploy.
Right.
But maybe one day, I don't know, I will reach that point where and I will have enough people to help deal with that side of the bureaucracy side, and
Right.
then I focus in what I really, really love doing, just talking to founders and making decisions. But yeah, that's one of the things that it will limit you on is that, freedom to, as an angel, you're totally in control because it's your own money that you're investing, and you just like something, you decide about it. Whereas a VC fund manager, you will be primarily bound by the mandate that you have, the thesis that you basically share with your LPs, and you cannot do. I mean, you can do few, but you cannot do, a considerable amount of investments outside of that. And especially on the geography, for example, you'll be totally limited to that particular area
Right.
that you decided on, and so on and so forth. So, but
Okay.
as an angel, I can decide to invest in US, I decide to invest in Albania, I decide to invest in UK. It's, it's up to me. That's that freedom that I love, and really, I mean, at this point, I'm kind of semi-retired, I would say, even though I have all these meetings, but I don't see them as work. I see them as
It's like a passion
like
project.
a hobby or something, and I love having all those meetings because apart from trying to find these synergies and whatnot, I also use them as a way of keeping up with what the future is building. I don't read news because the news is going to tell me the past, and I just use these meetings to learn from the founders who are really deep into what they're, in the verticals that they're building. They're very deep and they have so much knowledge and so much of what the future is going to bring, and that's a way that helps me understand where the overall market is going to go. And I love doing all this, and as a manager, you generally be limited to what is already pre-qualified in sense, probably from other people under you, probably from other tools, and you don't have all this luxury of taking meetings, even though you might not invest in them. So yeah, these are like the freedoms that I love to have as an
Gotcha.
angel.
I think we have our tagline for the episode title or something. You don't read the news because the news tell you the past, and talking to founders give you the future. I really like this vision,
Yeah,
and it's in the end when you make an investment, you are taking a bet on the future. So it's so important that you have this vision of the future.
absolutely.
Thank you for sharing this. Now we're gonna move to our flagship segment, which is this or that and yes or no. Very,
Right.
very creative names, I know. As you probably hear from the title, the format is fairly simple, but we try to make it quite proactive and dynamic. I'm just gonna ask
Right.
you a bunch of questions. Option A, option B. You pick one or the other. If you want to say both, you can say both. It's not cheating. There's no penalty points or anything.
Right.
You can say anything you want. And then after this, don't worry. You don't have to explain your answer because we will have a discussion about this just after.
Sure.
Everything
Okay.
good?
Yeah.
All right.
Yeah.
Let's go. So, do you prefer warm introduction or cold email?
Warm introductions.
What's more important, the founder story or the market size?
Founder story.
Do you trust more your gut or the structured diligence that you're going to put in the company?
Both.
Okay. Do you prefer investing in a direct investment or do you co-invest in an SPV, for example?
Always direct.
Angel or VC?
Angel.
Active angel or hands off?
Active. No
Now,
fun. The other. No.
Do you prefer reading the deck first and then having a discussion with the founder, or having a call and then talking about the deck?
The deck first because I want to see alignment.
Gotcha. FinTech or health tech? Which one do you prefer investing in?
Fintech for the money, health tech for what it does for the world.
Gotcha. So that's the impact part.
Yeah, both. Yeah.
Early stage or Series A? Which one do you prefer investing in?
Early.
Serial founder or first-time founder? Which one do you prefer investing in?
Serial, unfortunately.
Technical founder or commercial founder if you had to only keep one?
Commercial.
US market or UK market?
US.
Is that only for fintech or does it also apply to health tech?
Everything. US is an enormous market.
Gotcha.
And there's a difference in how they do business. We'll talk later on. But
Sure. Do you prefer leading or following?
following most of the time because of the check size.
All right. So a couple of these were easy for you to answer. Some of them we had already answered. Angel or VC, active angel, hands off.
Yeah.
Some of them you had some hesitation. Let's start with the warm intro and cold email. I felt like you wanted to say kind of both, but warm introduction comes with a bonus. Am I correct?
Yeah. So, I mean, a cold introduction, a cold email, it's great, but with a warm introduction, I kind of have already a higher starting point. In an essence, when I get these warm introductions, the people that are sending them to me are, doing me a favor, and they're kind of pre-qualifying some of those deals for me. For especially for things that I can go back to them and ask to get another viewpoint that I might not be able to get in a cold outreach.
Right.
The very, very important part for me is knowing the founding team. And that's something that I can, drill on more when I get a warm intro, because those people most probably know them very, very well, or at least, up to some level, that
Right.
they can give me another viewpoint. I can drill them more and more on, things that they've worked in the past together or whatever. Whereas with a cold intro, I'll do my due diligence, of course, but I don't have, let's say, somebody that I trust to go back to and drill them a little bit more on the founding team and
Right.
their prior, things that they did and whatnot.
In
So
that
that's
sense,
why I prefer the warm intro, but I take lots and lots of other meetings as well
okay.
with cold intro. It's just that if I had a warm intro, I would have that opportunity of going, back to them and asking more on founding.
Right. In that sense, would you say as an angel investor, for someone, for example, in our audience, someone wants to start angel investing, they're a founder that exited, or even a fund manager that wants to do a bit of angel investment on the side to have some of that freedom. We've had that a couple of times on the show. Would it be something that you put a big emphasis on to develop this network of venture scouts, of people working, venture builders, accelerators? How much importance would you put in creating that network that brings you ways of saving time, essentially? If someone brings you a company and they've already done that, we had a fund, I believe I talked to a fund, not on the podcast yet, but someone who told me that they don't take any applications, they don't have any scouts, they don't have any analysts, they don't do any due diligence, basically, or a very small amount. They only take stuff that has been pre-curated, and then they focus on the executive operational part. How
Yeah.
is the importance you attribute to that knowledge
So
before versus what you bring after?
okay, so I'll tell you the kind of warm intros that I prefer. The really, really good ones that I like are, and I'm going to share here a secret that I usually share with my customers as a strategic advisor. Investor relationships are a tradable asset, and founders who understand this and execute well on it are the ones that are really successful one. And so in that sense, the really good interests that I prefer are from founders. And one of the reasons that I have all those meetings is also this one, because I can ask them on other founders that they know on opportunities that are aligned with my thesis. And so that's one of my preferred way to get introduced by founders from other founders.
Right.
Now, of course, other investors as well are going to be, a good interest, especially if I trust their, them, and I like their investing style and their analysis style and all that, and their decision making process. If I trust them on those, I'd like to get interest for those. But in general, investors, deal flow is a tradable asset as well.
Mm-hmm.
And so investors will not really share much deal flow with other investors unless they have like a high, strong need for getting funded, and they want to push you that. But a good deal is a tradable one, and they usually don't share that with all investors, and they will share that with other investors that they also have good deal and they can trade with. And it's the same thing. So when founders can trade investor relationships, investors trade deals. And so that's what that's where I'm focused mostly in and I've been focused mostly in building these founder relationships where they can tell me about those top of the line, let's say, 1% or whatever founders that they know from their past, and they're building something great, and probably they are in this accelerator program or wherever they are, and they,
Mm-hmm.
they have this gut feeling that these guys are going to do something great. I love those kind of interests.
Gotcha.
And also from founders from my portfolio companies. Those, do start at a higher level on my evaluation, basically,
I see.
when I receive those interests. So those are the things that new investors should be focusing on building relationships with founders and other investors. But if you're early, you don't have much to trade with other investors.
Mhm.
So basically, work on your way with founders and ask founders and see who they can, who they can introduce you to that's aligned with what you're focused on. And you're going to be doing them a favor, and they will be doing these other founders a favor, and it's a win-win-win for everybody
Of course.
because they can trade investor relationships, and they help basically each other raise funds, and they help me get good deal flow, and so on and so forth.
And there's no, I'm not going to say conflict of interest, but there's nothing that cues the judgment. If, as you said, if you're an investor, if it's a really good deal, you want to keep it for yourself. That's it. Have the
Absolutely.
equity there.
I mean,
Whereas as a
yeah,
founder, you have maybe a more pure vision. And if you really trust someone, well, it's not going to be a competitor space, but if it's in a similar space, they probably also have that technical expertise of that space to detect, okay, I know they're real good. And
yeah.
you also, as a founder, you hear also who's full of bullshit and who's not, which is things that an investor might not tell you exactly, or they just might not access that information. The information doesn't always permeate from the founder layer to the investor layer. But in between, what we call in French, the corridor noises of
Yeah,
who did
exactly.
what and the personal things, this is the precious stuff.
There are many things there that are precious, but one of those is that with an investor, you try to be your best. With other founders, they can see your real version of you, and you're more vulnerable in most cases when you talk,
Mhm.
and talk are open to the issues you're facing, and maybe they even heard you when you were talking to mentors around, and they heard your issues, so they know who's real and who's not. Absolutely, that's one of the best reasons. And also, yeah, there is absolutely no conflict of interest. It's even if so founders, I tell this, they should understand, even if you are in closely similar kind of vertical or whatnot, investors will not invest all their money in you unless you're a
Right.
very, very direct competitor. Then of course you're not going to help them beat you to the race. But if you're in the similar, it doesn't hurt you because investors will diversify,
Of
and
course.
so they will not invest in only one company. So that's the thing. The other thing that kind of keeps this deal flow good for me is founders know that if they bring me 1, 2, 3 bad deal flows, I see them, then I will not take their interest anymore. And so that relationship that they have with me, they broke it, and they cannot trade it anymore with other founders.
I
And
see.
so it self-regulates in a way, and it's a win-win for everybody, as I said earlier. So
Beautiful. We had an early discussion during the question. You said, "Oh, we're going to talk about this later about the US and the UK market." And I asked you because US is known to be very proactive, writes bigger checks, bigger valuations, and everything. Lately, from my personal experience, I've been hearing a lot of people talking more positive about the European market for certain topics like the biotech, like impact, that are more healthy in Europe because those are domains where ultimately being more risk averse earlier on pays off in the later stages. And so I was surprised to hear that for certain things, the European ecosystem is one that is more sought after from certain type of investors. It seems that in your domain, the US is better. Can you tell us why?
it's bigger as a market, that's for one. The other thing is they've been doing this for quite good amount of time, and so there will be playbooks, there will be workflows, there will be documents, there will be things in place that you are not going to have a hard time going through all those steps. And Europe is trying to act as a union, but it's really 27 markets. And the whole issue here is that
How they
you're going to have
permeate
different
from one
languages
another.
that you need to approach your customers on. You're
Yeah.
going to have different, document requirements, and even raising funds from investors, in all these different countries is not a frictionless process, and it's suffering and suffering and suffering. Now, Europe is good at what you said. For example, Germany is getting very, very good in biotech and healthcare and all that's, med tech and biotech. And they really prefer these kind of deep tech opportunities, and they're pushing hard on that. But on the other side, Germany doesn't take too much risk on other opportunities. So they want to find deals that are really guaranteed in a sense, or really,
Gotcha.
really low risk. And the rest of the Europe is kind of the same approach, not much risk taking. Now it's improving, but it would be great if these frictions between all the countries and would be removed for investors and for founders.
I see.
If the union actually acted as a union, and it'll be one whole market. Now, the things that I see and I say and to founders as well is you could have the whole Europe, and to me it will be roughly compared to 1 or 2 states in US
Okay.
as a market for
I
market
see.
size. The other issue and why I prefer US is there's a difference in how the business is conducted. In US, the default is yes. Now, in Europe, the default is no. And what that means is in Europe, you have to first prove yourself, who you are and all that. And they will keep you around with these diplomatic answers where they say, yeah, let's see, and whatnot. And after 6 months or 1 year, you find out that they didn't even want to do business with you in the first place. Whereas US will accept you right away, but their BS barometer is very low. So if you start messing around, you're just gonna be, thrown out of the door,
Gotcha.
and they don't want to deal with you anymore. But that helps founders because you understand right away if they're for you or not. You don't want to be spending all this time in this lingering period where you're not clear if they're gonna go with you or not. And so that's what you really want. And I hope the culture will be changed to that here as well. And I believe with Gen Z and these new younger generations, it's going towards that where this diplomatic kind of keeping you around and being politically correct,
Right.
hopefully, is not going to be applied to how you do business. If you like and want to do business with them, tell them that. If you don't, then tell them that you don't want to do business with them. You don't like what they're offering, because that will help them. And
Yeah.
don't keep them lingering. It will, destroy them by spending all the time and capital in building something that, as customers are not going to like. And so that's why I
interesting.
prefer US. Yeah.
It's interesting. I think so. I was at this conference last week, the Blue Economy Finance Forum in Monaco, and so I now get to approach investors in a way that I would have never dared to do so as a founder. And same for founders. I can ask questions, maybe a bit more cheeky when I ask about something, and they tell me, "We have this capacity." I'm like, "Okay, give me, what are your production numbers? Are you making revenues? Yes, no. Don't try to
Yeah.
sugarcoat it." And sometimes it feels borderline rude because it's the ecosystem might not be used to. But yeah, I would be so much more, I wouldn't say aggressive, but I would be a lot more direct in the future. Back as a founder, you have to do this whole diplomacy. And even back then, my co-founder was the good cop, and I was the bad cop in the sense that he was a bit more diplomatic and I was a bit, go in, which sometimes can have a risk, and it's all about understanding that risk. So that's it for the this or that segment. We have the yes or no, which it tends to be the same. I ask you a bunch of questions, you say yes, you say no. If you don't know how to answer, you say skip. But it's purposely one-sided. It's purposely Manichaean because I think it's what gives the most interesting discussions right after. So let's go with a yes or no.
Yeah, sure.
Have you ever funded a company purely based on the founder, ignoring the deck completely?
Not yet.
Do you want to one day? Is that a dream of yours?
Absolutely.
Have you ever passed on a deal and later regretted it?
No.
Do you review all of the financials fully for all of the deals that you look at?
I review the financial only if decided to do due diligence.
Gotcha. Has your mentor ever disagreed with a specific investment that you made?
No.
Have you ever been wrong about a founder and it surprised you completely?
Yes.
Do you think angel investors are underrated in the ecosystem compared to VC?
Absolutely.
Have you ever invested in a company that was clearly outside the thesis and it was just because of the founder and the gut feeling you had with them?
Yes.
Would you ever become a fund manager if the structure was already prepared and you wouldn't have to deal with all of those freedom encumbrance?
Yes, because I could support more founders.
Gotcha. Are you satisfied with the quality of your deal flow today?
Yes.
Are you satisfied with the quality of the tools you have to maintain that deal flow?
Yes. I could be helpful a bit more for filtering, but yes.
Would you do it all over again?
Absolutely.
And finally, are you having a good time on the show?
Yes, love it.
Beautiful. So a lot of questions I want to get back on here. Have you ever funded a company purely based on the founder, ignoring the deck? You said not yet, but you would like to. Can you explain why is this a dream? It feels like the whole love at first sight where you don't know the person, but it clicks. Is it a bit of the same feeling that you want to have one of these?
No, it just hasn't. Actually, no. I did invest in one company that the founders didn't have a deck at all. So that went out of my mind. I
Okay.
invested in a company, and actually it's from two founders that are Albanian, but the company is US based, and
Okay.
it's also outside of my thesis. Now, these guys have their prior experience, and they came and met me in person. They didn't have any deck or anything. And so that's the discussion didn't start for an investment. It just started, I was guiding them a little bit and all that. And then when I decided to invest, they didn't even actually give me a deck. But in general, I get approached by having the deck being sent first. It's not
Right.
that, I absolutely would need the deck if I start building a relationship with you and I know you and so on and so forth. But it's just been that the deck has been sent as the first, material, and that's where it started. But yeah, I have actually done in this one particular investment.
And what would you say
That's
made the difference? Like what made this exceptional case possible?
yeah. When I make decisions in these early stages, it's always about the founder and the founding team and what their prior experience is all about. And if they had their lessons, if they had their successes, and these two founders, of course, had their lessons, but also their successes, and they were building something that connected to the issues that they had faced before.
Okay.
And so that, problem founder fit is a good signal for me and their prior experience. The thought is always, I mean, we're just guessing at the end of the day. There's no guaranteed in this, okay?
Of course.
But we're just trying to minimize the risks in general. So we're risk managers. As investors, we're risk managers. And when those things are there in place, like the problem founder fit and their prior experience is there, that the biggest risks, related to the founding team are kind of removed because they will find a way to make it succeed. It doesn't matter, the obstacles that they will face. They know things from their past that will help them overcome those obstacles. And
Gotcha.
even if the idea is bad, they will pivot. They will eventually reach a point with the product that the market is going to be, pulling from them. And so that's basically what would make the exception. It will be the prior experience and the actual strong fit with the problem that you're trying to solve.
Right. And
Yeah.
so another question we had here was, have you ever been wrong in the founder and about someone, and then it surprised you, whether maybe you thought they were wrong and they were correct or something? Can you
Yeah.
tell us maybe one of those experiences and why that happened and maybe the learnings you got from this?
Yeah, yeah. So my second exit was from that founder. So when I was listening to the pitch and asking questions, the way he was answering, it was very kind of laid back, and but that gave me the impression that this guy don't care, and I felt that he would not be a good partner to work with. And but then I looked more into the deal, and I saw the numbers, and I saw what he was solving, and I understood that was actually laid back because he was doing a great job and he was at a very good position that he didn't need to put the extra effort to convince me as an investor to
Gotcha.
come in. He just let his work convince, me for itself. And so that's where I got my second exit from, a 9.5x in less than a year and a half. And so that's these are things that the gut tells you it could be a problem, but then when you go deeper, then you understand that there might be something else there
Hiding
that's
behind.
not related to what you were feeling or thinking. And so yeah, that was one
And
case.
in that sense, I'm continuing to what would usually be the part three of the podcast, but it's here we're just going to do we're going to change the format a little bit and do an extended discussion based on some questions that I had planned for part number three, but I think they are actually within the same topic of what we just discussed. That kind of impression that this person gave, do you think they did it with you because you were an angel and they would have done it differently with a VC? Or like, is there a difference in the way that one should pitch to a VC versus pitching to an angel? Is there a difference in the behavior, the different metrics that you show?
Yeah, I mean, in general, there is a bit of a difference, but not that big of a difference. But in this case, he was pitching to a group of investors, actually, not
Okay.
to me alone. And so my assumption is, of course, I never thought that he was doing it particularly for me, that, that kind of behavior. He was just that he was at that point that he didn't need any validation or anything. He just knew what he was doing. He had a plan in place and he was going to get to where he wanted to go either way, and was absolutely clear for him. So I mean, for the way you approach the pitching, the VCs expect to see different things versus angels. Angels initially are primarily focused on the team, and because you don't have anything yet, especially in the early stages, you don't have things yet in place, and then from the team cohesion, then it's going to be how fast you can build a product and how fast can you validate and so on and so forth. But then VCs will generally, and that's when founders should really focus on bringing VCs on board, because otherwise it's not going to be as helpful. VCs basically will come in at a level where you have found a product market fit, and the market is liking what you're offering, and on top of that, you have clear unit economics, and how much you're spending to get a customer, and then how much that customer is bringing you back, and for how long, and so on and so forth. So it's a playbook that you just now need the capital to execute on. Because if you don't have that, and you get the capital from venture funds, they will not allow you to get the money and keep it in the bank, because they can keep it themselves. And they want you to take the money and go out and spend it, and either become a success or a statistic. They don't care. I mean, they, in some sense, they care, but their business model is such that statistically they expect 50% of the investments to fail. So, but those that will go on and make, those few that will make it big enough that they will bring back the fund and some returns on top. So that's the whole approach. You show different things to these different investors, right. And there is a little bit of a difference in the approach, but overall, for example, the attitude that you show should, there is not big of a difference in the attitude. Now, this particular founder, it was his kind of character that way. It's not something he was kind of acting or pushing or whatever. Right. Now, I have had other founders who, have been aggressive, quote unquote, in their approach. And I can see that from a mile away, that they're trying to act and they're not that, that person. They're acting. But he was not this way.
Right. Let me throw in not a curveball, but just not a counter argument either. But, you say that you're pitching differently to angels and VCs because VCs expect a different thing from angels, and they usually come at a later stage. Now, the question is, what about the early stage VCs? Does that actually invest pre-revenue and all of that? They are out there, and do they just have a different thesis that makes them want to be like an angel, or do they have something different? Like, what allows them to exist? Or do you think maybe what you think is that they're an aberration, they should not exist? But yeah, just interested in those that do the same job as angels in that sense.
Yeah, there are some VC funds who have arms for these earlier stages. Some do it well, some are just in the pretending game. The difference with those that are doing well is that they bring not only the capital in those early stages, they will bring something towards what angels are bringing as well, in the sense that they're trying to build companies and then connect with their own later stage funds or other funds as well. But they will also have a good team in place to get you to market very, very fast. And in general, they will be working with these founders that have some sort of experience, and usually there will be founders that are that have been backed from them before, or they're founders that have a good track record.
Gotcha.
A first-time founder to be backed from them should be building something very, very exceptional. The others that are just playing the games and see how things go, you don't want to really partner with them either way. So
fair enough. So now we're approaching the hour mark here, and you've been very kind to share all of that experience. Now, beyond the experience is the learning. You learned a lot from your mentor above, and then you learned a lot, of course, by doing. Let's see. We have around 10 minutes left, and I want to brainstorm on something like the 10 commandments of angel investing. We start to tackle this. Let's try to keep it brief. if you were to make the 10 commandments of angel investing, maybe some of the key learnings, the essence you can distill from all of the years from your mentor, from the mentors before him, you go back in time, and now that curated by your own experience, what would those be? Of course, there is a standard: have a thesis, stick to the thesis, have a good due diligence. That's the standard stuff. I
Yeah.
want to hear the level two. What's
Yeah.
behind or what's written between the lines? Do you
Yeah.
think we can create something like this? Come up with some of these, the 10 real tricks, the secrets in there.
I mean, I'm not sure I can go up to 10 tricks now. I have to sit down and think, but the most important part is stay focused in what you understand.
Right.
That's one for sure. The other is try to build a network around you that can, either help you get deal flow or helps your portfolio companies.
Right.
The other thing is do good due diligence. Don't just go with the flow. Even in those cases where you you decide not to invest without a pitch deck, still, try to go deeper and understand more in terms of the founding team and then in terms of the actual business opportunity, what they're building on.
So industry.
The other thing, before you make an investment decision, try to learn more on the mechanisms of the investment. If you're investing into an SPV, understand what it means, understand what costs come with it, understand everything. If you're doing direct investment, understand what the terms are that are generally put into those deal term sheets. Basically, try to understand the meaning of the terms, because sometimes there will be things in there that are going to be missing for you, and you will assume, and they're definitely not there. And one of those, like I learned, the hard way a bit back when I did a few investments to SPVs, that you don't have information rights. The manager has information rights, but you don't. And that's one of the reasons that I don't do now SPVs anymore.
Gotcha.
And so get yourself accustomed to the terms that are used in these term sheets. Absolutely critical, because that's what really stands at the end of the day. All the words, everything, discussions, whatever you talk with founding team, generally will be thrown out of the window if the hard time comes. What else? Yeah,
We've got four.
don't.
We've
So
got four
so
so far.
yeah, the other thing is there is a statistical kind of rule that you need to be diversified enough for this model to work. And the number is somewhere up to 25 investments or so.
Okay.
Because the expectation is that, like I said earlier, half of the deals you will invest in will fail. Some others will bring back part of the capital, or, all the capital you put in. But those that will be bringing in good numbers, like 10x, 50x, 100x, will be few. And so the more diversified you are in the terms of number of deals, not diversified in terms of the verticals or whatever, but in the number of deals, the higher the statistical chances are that you will get those few that will succeed, because it's a game of numbers. If you invest in 5 deals, let's say, and 2 or 3 of them automatically fail, then you have very few that will have that chance of bringing you that 50x or 100x. So the kind of golden number is not the golden number, but the minimal statistical number is at around 25 investments. So when you make your decisions on how much to allocate for each deal, try to stick around there. Now, I know the other ideology that when you're concentrated in a good deal, you make lots of money and whatnot, but that's on a hindsight. On hindsight, we're all great investors. On managing risk, this is a system, and you need to put a system in place to be able to manage the risks in such a way where even if those things happen, chances are that you're going to get something back. And one of the other things that my mentor told me as well is, especially in the early days, try to keep some of your investments in the more advanced stages. Don't keep them all in like very, very early stages, because even if you lose all your earlier bets, chances are that those later bets are going to bring in back some of the capital, and like your capital and some returns on top. And in your case, this has worked well, especially for angels who are trying to get into this. Do not start writing checks. Just go up there, have 40, 50, 100 pitching sessions and think if that's something you'd invest in. Don't decide to invest. So don't do the investment. Just work out if it's something you'd be investing in, but don't invest. And then after you have heard so many, and especially if you're going to be in group pitches where other investors can share their thought process as well, it will be helpful to you. So join those meetings if you can, where there are, a group of investors, that there will be pitching sessions, because that will help you understand how investments are being viewed at. The questions they were asking and stuff like that will be very, very important for you to learn. So have all these pitches before you actually decide. Also, one important thing that I put in place is I don't make decisions right away. I listen to the pitches and all that, and I give myself some time to go through the due diligence. Of course, it's going to be 2 weeks, 3 weeks, and during this time, that initial rush of I want to invest now fades out, because you see more things in the due diligence, you see
Right.
more things in what the future is bringing and all that, and that kind of gives you the better viewpoint. So don't rush the investment decisions. Even if people are rushing you, invest now or lose. Don't ever do that. You invest at your own pace and you make your own decisions. Don't let others make your decisions for you. I get pitched about 1,500 or so a year, and all these pitches. And I tend to invest I aim to invest about 5-7 investments a year. So I can afford to miss all these hits and I still land on the good ones. So even if something good, you're gonna miss it because somebody was trying to force you, it doesn't matter. You'll find something else.
Yeah.
So stay on your terms, on your pace. It's not worth to be bullied around for money. That's the whole thing. Stay on your decision making process and the systems. These are some of the things. I mean,
We're getting to 7 or 8. It's a very good list. I'm
yeah,
very, very satisfied with this. Honestly, it's very
yeah,
insightful, very, very
yeah.
important, and you really boiled it down to a couple of words for each. So thank you so much. Just a little question on the when you said train first before writing the first check.
Yeah.
What would you say is what makes it click? What would be the signal that you wait for to say, okay, now I'm ready. Like now I can write the first check.
Right. It will eventually come to that deal that you fully understand, and you're ready to risk it. What would be a click? Now, for each one, it's a different one, but I personally would be at that point where I have at least like 10, 15 decisions that I said I would invest, and I let them go by, and then I come to this one where I will really take it on. 10,
Gotcha.
15 decisions. I let them go by. You need to train your mindset to let investment decisions go by, because it will happen. You should not be clingy to each and all, deals that come to you.
Hmm.
And if you do not train yourself to let even good deals go by, then you're gonna be making bad decisions all over, because
Right.
you will always think that all deals are good, and you don't know what deal is good until some time has passed. So make those decisions and let them go by. Give yourself 6-7 months to go through this process of not investing, just learning, and then see how those deals that you thought were great are doing. What's
To
their
validate
progress,
the
and
mindset.
and and, and so if overall you're satisfied with what it would have been for you if you invested, then you start writing the check on that first one, and then keep on looking at the progress,
Gotcha.
and don't rush, don't make investments one after another one. Just give it some time. Let something go by. Now, is there going to be some great investment in those? Yes, chances are that it could be, but it doesn't matter, because you're building a system that works for you. Because if you don't build that system, and have it in place, I said earlier, you will think that all deals are great.
Right. It's incredibly. I already used the word insightful. I don't like repeating myself, but
Yeah.
the amount of wisdom you just shared here is just great. It's incredible. Thank you so much for saying things that are also hard to hear, because when you're an angel and maybe you just made an exit, you want to reinvest. You've been told that sitting money and sitting capital is never a good thing. So you don't want to leave it all here. And patience is a virtue. especially in
Yeah.
the world where, in that world of early stage venture where things happen fast, they need to happen fast. You need to grow fast. On the investor side, you need to take your time.
Yeah,
And this
absolutely.
asymmetrical perception of time and the importance of time is very important. It's very interesting because you're saying as an investor, what you're looking at, especially in the early stage, the pace at which a team can deliver on their promises. So you're looking for the speed, but on your end, you need to simmer down and process this, sleep on it. That was very insightful. Thank you so much. Chef,
Yeah.
I think we're getting even past the hour that we had allocated. I really wanted to thank you so much for sharing all of this, all of these years. It's really the the mindset, the objective of this podcast is really to get those learnings and make them accessible for our community in a nicely digestible format. It's my job to help you put it in this format, but I think you also did it. You did a perfect job at helping me in this task. So I really wanted to thank you again. For our audience, of course, if you want to hear the full episode and you're only listening to a few clips or so, it's available on Spotify. It's available on YouTube. If you're on Spotify, you want to see our beautiful faces. This is why we have the YouTube. And if you want to share some of the smaller clips, some of the snippets of learning, we also do reels and shorts on Instagram and on YouTube. All of the learnings will be in our repository. At the date we're recording this, which is early June, I am using all of my cloud credits in building this repository where if you want to learn, for example, you're a new angel investor, you want to learn about how to create your thesis. If you are an investor already or a founder, you want to learn how to curate the right team, what to do in the pitch, you can look at those keywords and you will find all of the learnings of Chef and any other investors we had on the podcast, all distilled and made ready and available for you with the right timestamps to the right episode. So that's the big additionality of this episode and this podcast as a whole. So, Chef, thank you so much for participating in this whole endeavor. And I don't know, do you have any closing remarks, any last word, maybe any investment field that you're really interested about? And if there's anyone that listens to us who has an interesting project within that topic, they want to reach out to you, what could that be?
Yeah, so thank you for having me. I loved all this and drilling down on all those topics. If any founder is interested in getting investment or advices from me, I'd be happy to be connected on LinkedIn. Always, accept those connections and DMs from founders. So if you're building anything in the verticals that I'm focused in fintech, ad tech, or healthcare, I particularly look for things that have an impact as well in terms of doing something good for the humanity overall. So those are things that really excite me and to be involved with investment, but also with my expertise and network and all that. So reach out and I would love to learn more on what you're building always.
Beautiful. Amazing last words. Chef, thank you so much. And for our audience, we will hear you in the next one. Chef, thank you so much. Cheers.
Thank you. Thank you for
Thank
having
you.
me.